Please remember that futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I author in my weekly written reports. Prices shown on charts and quote bars are in real time and take into account all known activity up to this point in time. If you'd like to read more of this disclaimer, simply hit the pause key on your computer screen. I'm Boyd Baker, and thanks for tuning in to another options tutorial. Today we're going to review some bull strategies, and in specific, a vertical bull call spread. Now in the past videos we talked a little bit about the option ladder and some of the more bullish strategies or bearish strategies or neutral strategies. Let's focus in on the bull strategies here today. Now if you've been following these tutorials, you should understand by now what we mean by buying a deep in the money call. You're going to have a delta which is very high or close to a one-to-one relationship with the underlying futures. When you're buying an at-the-money call, remember that your option's moving about half as fast as the futures. And if you're buying something that's way out of the money, a long call out of the money, it may only move at about a 10% delta. Today we're going to focus in on the vertical bull call spread. And typically that's going to move at about a 20 or 30% delta to the underlying futures. Now what is a vertical bull call spread? Simply it's when you're buying a call and then selling a call of a higher strike price against it. Now, the gain on this is the difference between the strike price that you're buying and the strike price that you're selling, less the cost of the spread. It does have a maximum risk. It is a debit spread. You're limited to the cost of the spread. Of course, you'll have a couple of transaction costs on this. And you're going to want to establish this trade when you're bullish the market, but you don't want to spend a lot of money. Let's take an example to show you this. And in this case, we're talking about the crude oil market, and it's made a big move from about $100 here all the way down to $45. It's bouncing around right now, and it's just below $50. Let's say that you believe crude oil has a chance to go back up, maybe into the $60 or $70 range. One might consider a vertical bull call spread. Instead of buying an at-the-money option, which might be very expensive, you might consider buying the $60 call and then writing or selling the $70 call against it. In this example, if you went out about 3 months, the $60 call is going to run about $2,000. The $70 call that you sell against it is trading for about $500. Your net cost on this spread is going to be $1,500. That's the maximum risk that you'll have on the trade, of course, with the transaction costs. Now, there is also a maximum gain on the trade. And we talked it's the difference between the strike prices. If we have a $60 call that you're buying and a $70 call that you're writing, that's a $10 crude oil move, which is $10,000 in futures terms, less your $1,500 that you spent on the spread. Your maximum gain on this trade is going to be $8,500. Of course, you'll have 2 transaction costs. So, you're going to want to establish this trade when you're bullish the market. You don't want to spend a lot of money on an at-the-money call. You're writing an out-of-the-money call against it to help reduce your costs and help reduce your risk. In this case, you're spending $1,500 to potentially make $10,000. Your maximum gain on this trade is going to be $8,500. If you have any questions on this, feel free to call me here at 866-973-2079.